by the federal government and the record deficit that it will create. The result, according to our next guest, inflation. It's on the horizon. We'd like to welcome Martin Feldstein, professor of economics at Harvard University and a member of President Obama's Economic Recovery Advisory Board. Professor, it's a pleasure to have you with us on our program today.
Good to be back with you.
Can you give us a sense of timing? We read your piece suggesting that all this spending is going to create inflation some way down the road. When does it hit?
Well, it's not so much the spending that's going to do it, because we've had fiscal deficits in the past without having inflation. It's the monetary policy that worries me. After all, what the Fed has done is to allow an explosion of reserves in the commercial banks. A year ago, commercial banks had excess reserves of $3 billion. They now have more than $700 billion. So that once the economy begins to recover, that could be next year, it could be late next year, but whenever it is, there will be a strong pressure to convert those reserves into a growth of money and credit, and therefore to start inflationary pressures.
Is this what's called classic monetary economics? It's the amount of money that you've got whizzing around that creates inflation or not?
Although in this case it's a kind of precursor to that money. It is the reserves that can be used by the banks to create the money that could, as you say, go whooshing around, pushing up demand, pushing up prices.
Now,
So it's not a risk now because there's so much slack in the economy, but once we start to recover, those very high-powered reserves can be turned into money and inflation.
Now, when you say inflation, I mean, I have visions of when I first came to America back in the 1970s, where inflation was really out of control, went up to 7, 8, 9, even 10% for a while. Are you talking about the same kind of inflation?
Yes, certainly that could happen. We could go back to double-digit inflation. Now, that's not built in. It depends on whether the Fed can control that. But that's going to be a technically difficult thing to do because of the way they have built up this large amount, absolutely unprecedented amount, of excess reserves.
We keep hearing, and putting it in layman's terms, that the Fed is just printing money. I realize it's not printing $700 billion worth of $100 bills, but nonetheless it is creating money, isn't it? I mean, is that the source of all this money?
Well, the money supply, the amount of checking accounts and savings accounts is up at an annual rate of 15%. So in that sense, money is growing very rapidly. But these reserves are the result of the Fed buying mortgages, buying commercial paper, buying other kinds of loans, and in exchange, giving money to the banks, which they hold as reserves. So the Fed is creating these reserves by the way it's managing credit policy.
Real fast, Professor, could you look at the other side of the ledger, and that would be the near $2 trillion deficit this year? Briefly, what would be the impact of that, do you think?
Well, one impact, and it's not just this year, we're going to see deficits year after year for the next decade, doubling the share of the national debt relative to GDP. One of the things that's going to mean is much higher taxes going forward just to pay the interest on that debt.
Why would you put your name to the President's Advisory Board when you're spelling out, when you're looking at a policy that this President is putting into place which has such dire consequences? You have one of the best names in American finance. Why is your name on this advisory board, Professor?
It is not part of the administration. It's an independent advisory board. Paul Volcker, who's the chairman of it, said, please come on board. The president wants independent advice, critical advice. And I thought, if there's going to be policy made by this administration and I can influence it for the better, I'm not there to say it's good policy. I'm there to try to make it better.
Fair enough.